Hey everyone, and welcome to Crypto Turtle, where we're focused on everything cryptocurrency and the mindset of the turtles. Here we provide video breakdowns of current crypto trades, we track the performance of the top cryptocurrencies at our website, cryptoturtle.com, and we tweet out new trend breakouts and market digests. If any of that interests you, then please like this video, subscribe to our channel, and follow us on Twitter. We really appreciate that, as it helps us grow the channel and continue to bring you the best content that we can. Before we get started, we need to let you know that this or any of our content we provide is not financial advice. Please do your own research and please make your own decisions. All of our content should only be used for informational and entertainment purposes only. Now that that's out of the way, let's get into it. So you're probably wondering, what does cryptocurrency have to do with turtles? Well, to answer that question, we need to go back to where the original turtles were born, by a famous experiment conducted in the early 1980s by commodities trader Richard Dennis and his partner, William Eckhart. Dennis and Eckhart had a disagreement on what made a successful trader. Eckhart believed that successful traders had an innate ability to trade the markets and were born to trade, while Dennis believed that good traders could be taught. To settle the disagreement, the two set out to create an experiment. The parameters were that Dennis could handpick a small group of approximately 20 novice traders, teach them his trend-following strategy and trading principles over the course of a few weeks, and then allow them to trade accounts with his own money and track the results. The makeup of the people selected was truly incredible, as all had quite different backgrounds. We had a doorman, an actor, a Harvard grad, a former Air Force pilot, an attorney, a programmer, an accountant, and more, all part of the experiment. So who do you think won the bet? As you might have guessed, Dennis proved to be right, with the results reported to be $175 million earned over the course of 5 years. We also saw several of the participants to go on to start their own successful trading firms in the future. These were the Turtles, a moniker given to the group by Dennis for the people selected to participate in the experiment. People who went from little to no trading experience to trading rock stars, simply by having a disciplined and pragmatic approach to their trading, rooted in well-established trading principles. The principles and rules that Dennis taught the Turtles, I believe, still resonate today and provide many lessons for us to learn from. Let's take a look at the core principles and rules that Dennis taught the Turtles. The first rule was to always follow the rules. Dennis and Eckhart back-tested their trading strategy against historical data and knew it provided a large enough edge worth trading. It then became the job as the traders to have the discipline to execute and follow the trading rules. Dennis knew that having a well-defined trading system was no value to anyone if they were not pragmatic enough to follow it. Second, Dennis preached simplicity. The Turtles traded only two systems, one for short-term trends and one for long-term trends. Both had simple and easy to understand entry and exit criteria. No complex indicators, no need for screens stacked upon screens to make a trading decision. Simple and easy to follow rules. Third, the Turtles only traded in the direction of the trend. The Turtles were taught to let the tide of the trend do the work for them. They didn't care which direction the market was trending, only that they were on the right side of it. They believed in the mantra of buy high, sell higher, or sell low and buy higher. Next, the Turtles were taught to always preserve their capital and cut their losses fast. The Turtles always used stops and always knew how much they were willing to risk on a trade. If a trade moved against them, they cut their losses immediately. No questions asked. Live to fight another day. The next rule was, let profits ride and add to winning trades. If a trade moved in the turtles' favor, they systematically added to that trade. They were always in search of the big moves and the home run trades. The turtles were much more fearful of missing out on a large move rather than locking in a small profit. It was not uncommon for a couple key trades to make or break a turtles' trading year. The last rule was to know when to exit a trade before you enter. This was a point that Dennis put a great amount of emphasis on, as his research indicated that exit criteria was vastly more important than the entry criteria. He believed that a good trader, with proper risk management, should always be able to manage a trade effectively once entered. Knowing exactly when to exit a position was always required of the turtles. So now that we understand the principles the turtles were taught, let's take a deeper look at the trading system Dennis had them follow. There were two different models that the turtles traded, the S1 system and the S2 system, both similar in nature and easy to follow. The S1 system is a shorter-term breakout system that has three components: the entry criteria, the exit criteria, and the filter criteria. To enter on an S1 trade, the turtles would wait for a market to break out, using either a new 20-day high or 20-day low as their entry point. If the market they were trading created a new high, they would buy, and if it created a new low, they would sell short. Remember, the turtles always traded in the direction of the trend, and they use these breakouts as an indicator that a new trend may be starting. For the exit criteria, the turtles simply waited for a new 10-day breakout in the opposite direction of their trade. This meant if the turtles were long, they exited on a new 10-day low. If they were short, they waited for a new 10-day high. The last piece of the S1 system was the filtering criteria. The rule was the turtles only took the S1 trade if the previous S1 trade, regardless of the direction, was a losing trade. Or put another way, if the previous S1 trade was a winner, the turtles skipped the S1 breakout. The greatest benefit of trading the S1 system was potentially getting in early on a big move in the market. The drawback was you were more likely to see a higher variance in your returns as a result of more whipsaws and losing trades on breakouts that simply didn't materialize. The other system the turtles traded was the longer-term S2 system. This system at its core works just like the S1 system, except it just uses a wider time frame for the breakouts and has no filtering rules. The S2 breakout entry was a new 55-day high or a 55-day low in either direction. And to exit the trade, just like in the S1 system, the turtles waited for a breakout in the opposite direction of their trade, except this time using a longer 20-day breakout to close their position. The S2 system served as a failsafe for the turtles. If they didn't take an S1 breakout because of their filtering rules, the S2 breakout was always there for them to make sure they didn't miss out on the big move. The benefit of the S2 system is greater confirmation of a larger trend in the market. This tends to lead to smoother returns when compared to the S1 system. But the drawback is that there will be trades that don't have as high a return as their S1 counterpart. This is typically because you'll be entering later in the trend. Another critical component that Dennis taught the turtles was risk management. You can think of this as the glue of the system. It's the key piece that holds everything together. The first rule the turtles followed in this area was never risking more than 2% of their entire trading account on a single trade. For example, if the turtles were trading an account worth $10,000, the total risk for each trade would be $200, or 10,000 times 2%. That would mean if the trade they opened reduced their trading account to 9,800, they exited the position immediately. No questions asked. Now that we understand account risk, the next question we need to ask is how large of a position should we take? This is an area where the system really shined, as it tied position sizing to volatility. The more volatile an asset is, the less you buy, but the wider of a stop you use. The same holds true for the opposite case. The less volatile an asset was, the more you could buy, but you used a tighter stop. To measure volatility, the turtles used a 20-day average true range. The true range of an asset is essentially the total distance and price that the asset has traveled for that day or time period. The calculation is simple. You just take the largest of the three following calculations expressed in absolute terms. Today's high minus today's low, yesterday's close minus today's high, and yesterday's close minus today's low. Absolute terms is just a fancy way of saying always positive. So if one of your calculations is negative, you simply just ignore the negative sign and consider it positive. Let's look at a simple example of true range for Bitcoin. If the low price of Bitcoin for a day was 10,000 and the high was 11,000, we could say that the true range for Bitcoin on that day was $1,000. Check the description of the video for more details on how this is calculated. It's really simple. We now have all the pieces that we need to determine the position size of a trade. Here's the formula that the turtles used. Their risk percentage multiplied by their total account value divided by 2 times the average true range. Let's look at an example of how we can calculate this. Let's say we want to enter a new position for Bitcoin, and our trading account is $8,000, and the average true range of Bitcoin is 1,000. The calculation would look like this. First, our account risk for this trade, assuming a 2% risk, would be $160, or 8,000 times 2%. The volatility portion of the formula would be 2 times our average true range of $1,000, so in this case, 2,000. Making our position size for this trade $160 divided by $2,000, or 0.08 Bitcoin. Now let's see how we can use that average true range value to ensure that we don't lose more than $160 in this trade. Let's say we've bought our 0.08 Bitcoin at $10,000, meaning we now have $800 worth of Bitcoin in this trade. Because we've tied our position size to 2 times the average true range, we can also place our stop at 2 times the average true range from our entry point, which in this case would be $8,000. If Bitcoin were to hit $8,000, it would mean our 0.08 Bitcoin is now worth $640, which if we look at the original cost of our Bitcoin, we can see that $800 minus $640 is $160, which is the amount we were willing to risk, and we would exit the trade. The turtles called this a 2N stop, with N representing the average true range of an asset. What this means is that there will always be 2 exit criteria to evaluate once we enter a trade. It will either be our 2N stop or the S1 or S2 breakout exit. Whichever the two hits first is when we exit the trade. And that's the system in a nutshell. Breakouts for entries and exits with risk management driven by volatility to limit our downside with unlimited upside. You simply ride the tide of the trend until the end. Let's walk through some example trades using real Bitcoin data. The first part of this trade is the S1 trend breakout we received for Bitcoin on July 22nd at an entry price of $9,467. To enter this trade, the first thing that we need to figure out is how much we're willing to risk of our trading account and what our position size should be. We can see that the average true range for Bitcoin on July 22nd is $170. And let's say we have a trading account size of $5,000. A 2% risk for an account of $5,000 is $100. This means we will not allow our trading account to decrease by more than $100 or to $4,900. To figure out our position size, we multiply the average true range of $170 by 2 to get $340. We then divide our risk amount of $100 by that $340 to give us a position size of 0.29 Bitcoin for this trade. We now have everything that we need to enter our trade in Bitcoin. Let's say we were able to enter our position of 0.29 Bitcoin at $9,500. That gives us a cost basis for this trade of $2,755. To protect our capital, the next thing that we need to do is place a stop at 2 times the average true range from our entry point. In this case, that makes the stop for this trade 9,500 minus 340 for a stop of 9,160. Now let's consider the value of our Bitcoin if it were to drop to 9,160. 0.29 Bitcoin multiplied by 9,160 gives us a value of $2,656.40. If we look at the difference from our entry point of 2,755, we get an account loss of $98.60. This is just below our account risk of $100, which from a risk management standpoint is exactly what we're looking for. Now that we've entered our trade, it's just about managing our stop to the 10-day low of Bitcoin or our original 2N stop, whichever hits first. It's important to note that we should only be moving our stops towards the exit of the trade. You should never move your stops further away from an exit. Think of it as a one-way street. Stops only go up when you're buying and down when you're selling. You'll notice in the beginning stage of our trade, our stop is higher than the S1 breakout exit. That's because we can't allow our trade to generate more than a 2% loss in our trading account. But after a week or so, as the 10-day low for Bitcoin starts to get higher, we begin to use that as our exit criteria for this trade. We then can see on August 25th, the point when the price hits our stop at $11,375.13, resulting in a net gain of $543 on this trade. This pattern for our stops is pretty typical for a trade. At the beginning stages, the trade is managed by our 2N stop, eventually to be overtaken by the S1 or S2 breakout exit as they begin to get higher, or lower when selling short. It won't always be this way, but it's pretty standard. This brings us to the important topic of expected value. The turtles needed to know they had an edge. and Dennis was always measuring the performance of the turtles in terms of expected value. If we look at this trade from an expected value standpoint, it's very positive. We risked $100 to make $543. When measuring the expected value of a trading strategy, it's best to think of it in terms of multiples of our risk amount. For this trade, we would have a performance of 5.4, or 100 divided by 543. I encourage you to do more research on expected value and to backtest your trading strategy against historical data, as this is a concept that applies to any trading strategy. So let's recap. The turtles believed in the following rules and principles. Always follow the rules. The turtles were disciplined and pragmatic in their trading. They knew their trading system provided a positive expected value, and the only way to realize that value was to be disciplined in following their trading rules. Keep it simple. Part of what made them so disciplined as traders was the simplicity of their system. It wasn't hard to understand and easy to execute. Always trade in the direction of the trend. The turtles believed in letting the tide of the trend do the work for them. This meant they believed in the mantra of buy high, sell higher, or sell low and buy lower. Preserve your capital and cut losses fast. The turtles never risked more than 2% of their account balance in a single trade. If a trade moved against them, they cut their losses immediately. There would always be more trading opportunities in the future. Live to fight another day. Let profits ride. If a trade moved in the turtles' favor, they let their profits run until the conclusion of the trend. No arbitrary profit targets. Let the market tell you when it's time to close a position. Ride the trend to its natural conclusion. Know when to exit before you enter. The turtles always knew their exit criteria. The turtles used a combination of a 2-end stop with an S1 or S2 breakout exit. Whichever was closest to being reached is what the turtles used. This meant there was never any doubt when they would close a position, providing simplicity and clarity to their decision making. We looked at the breakout and risk management system the turtles used to trade. The turtles traded two different systems: the S1 system, which used shorter-term breakouts, and the S2 system, which used longer-term breakouts. The S1 system used a 20-day breakout for entry and then a 10-day breakout in the opposite direction of the trade to exit. It also contained a filter rule in which the turtles would only take the trade if the previous S1 trade in either direction was a losing trade. We looked at the longer-term S2 system, which used a 55-day breakout in either direction for entry with a 20-day breakout in the opposite direction of the trend for exit. This was used as a failsafe for the turtles in the event that the shorter-term S1 system filtered out a trade. Lastly, we looked at the risk management system the turtles used. This was the glue that made all the pieces work together. It tied an asset's volatility to the position side of the trade through the use of a 20-day average true range. The more volatile an instrument was, the smaller the position size they took, but the wider of the stop they used, and vice versa. We saw how the turtles used the 20-day average true range as part of their 2-end stop to ensure their position had enough room to move during the trade while protecting their capital. Thanks for watching. I hope you found value in this video. If that's the case, please remember to like, share, and subscribe, as it allows us to continue to bring you the best content that we can. Follow us on Twitter at Crypto Turtles, where we tweet new trend breakouts and provide market recaps. And lastly, check out our website at cryptoturtle.com, where we track the performance of the top cryptocurrencies against the original turtle trading system. Thanks again for watching, happy trading, and I'll see you soon.